So let's just talk about where we are and what we're doing today. And I'll be in New Orleans next week, just so you know, moderating this tax panel. So appreciate those who could make it here on Friday. And Lee was kind enough to videotape it. So hopefully, if you weren't able to make it here on Friday, you were able to see the videotape. All right, so in terms of material, last day with this book. I know a lot of you are going to shed crocodile tears, but we're going to just, what was that, Alicia?
We're starting already.
You're already starting shedding those tears. All right, so chapter 1, just broad overview, what are trusts, what are estates. Chapter 2, just talking about the similarities of how trusts and estates share into the same characteristics as would any other taxpayer, but of course there's some caveats to that, and you guys saw one of the main ones reflected in Manufacturers Hanover in the copy in pages 56, 57 in the textbook. And then we spent quite a bit of time on chapter 3. Chapter 3 dealing with issues pertaining to the computation of D&I and how so-called simple trusts are taxed under 651, 652, and then complex trusts under 661, 662. And with respect to complex trusts, remember every estate is parenthetically a complex trust, because estates, I've never met an estate where anyone says pay out all income. So if you don't pay out all income, you're by definition, right, in the world of complex trusts. All right, so we covered that. We covered 642H, dealing with excess losses. We covered Code Section 642E, that we make distributions of property. That what comes out, I know V, you're chomping at the bits to say 642E says what? You said it last week.
The lesser of the adjusted basis or the fair market value,
yes.
Whichever is lower. Yeah.
Whichever is lower.
Yeah.
It's considered distributed out, and then you can elect to recognize the gain if you choose. But to my knowledge, no one does that. And we also spoke, and we've seen this in the income tax course, the Keenan case, right? The Keenan case, in that you have to satisfy a specific request for depreciated property, it can trigger recognition of gain, right? We saw in one of the problems that gave rise to a gain recognition, a capital gain, and just to remind people that when the distribution was made, remember, you can never be taxed on more than D&I, but even though there was a capital gain wasn't counted towards D&I, so it was a little bit of a trick. I'm sure the authors did it purposely, but that can happen in practice, right? So just bear that in mind. All right, so we went through chapter 3, and we looked at, like I said, the complete, in my mind, the complete landscape of how simple trusts are taxed, complex trusts are taxed, and some of these extras of things that you should bear in mind. And then we've been spending 2 classes, and like I said, NYU has an entire semester on so-called grantor trust. Grantor trusts have a shared heritage with single-member LLCs, insofar as they are not a taxable entity, right? They are not a taxable entity. And as such, they are ignored for tax purposes. Code Section 671 says essentially that whatever income, deductions, credits, and the like get picked up on the individual's tax return. 672 offers a series of definitions that are useful in the context of Subpart E, Subpart J, namely what is an adverse party and what is a non-adverse party, and goes through some of those issues. And then we looked at different code sections, and akin, if you recall the Clifford case, Clifford sort of embraced all these indicia of ownership. And Clifford, the person who set up the trust in Clifford, had all these indicia of ownership. And what Congress did, vis-a-vis Code Sections 673, 74, 75, 76, 77, I don't have enough fingers on one hand, and 78, is that Congress enumerates those provisions in the trust which will trigger grantor trust status, which in yesteryear, grantor trust status was a real problem because people sought the refuge of having a trust because of the lower tax rates. After 1986, no one's seeking the refuge of a trust because the tax rates are compressed under Code Section 180, and therefore what in yesteryear was a sword by the IRS is now looked upon, depending on circumstances, fondly, where people say, gee, not being a grantor of trust is not a bad thing at all, right? And just, I mentioned this 3 classes ago, but what is the most common grantor trust out there? Just make sure everyone is a fill in the blank. Most common grantor trust?
Revocable.
Revocable trust, revocable trust, right? Because depending on what state you're in, revocable trusts are very, very popular because their use can avoid the probate process. Right? So revocable trusts enjoy immense popularity in states where probate's an issue. So virtually everyone I know in Florida, in California, for example, in both Florida and California, no one owns property in their own name. They own it in the name of a revocable trust, okay? That's just part and parcel of practice. So, and periodically, I will get calls from financial institutions from Florida or California, and they think I'm being derelict in my duties if I don't set up a revocable trust for their clients who reside in New Jersey, or New York, but that's just not true. Not necessary, all right? So just bear that in mind, albeit revocable trusts can have their place in practice. But aside from revocable trusts, there are, you do have to be aware that there are other forms of trusts that will give rise. For example, if a grantor sets up a trust with a reversionary interest, right? Code Section 673. Or if they have beneficial interest, that they can control enjoyment of the property, 674. 675 deals with administrative powers, right? 676, revocable trust. I have to check. The one, 678 was the last one we looked at that deals with where not the grantor, but the beneficiary. The beneficiary is treated as the owner of the trust because the beneficiary has such tremendous indicia of control over the trust that it's going to trigger ownership. All right, so you guys, let me pause there before we look at anything new. Any questions logistically or material that we've covered today? Just bear in mind that we do not have a class next Wednesday. Our next class will be 2 weeks. Our next class and final class before the exam will be in 2 weeks from now. In case you have to leave early or there's some other issue, keep in mind that our last class we will cover IRD, Code Section 691, and do not. I'm not going to stop you, but you don't need to read the material in this case book. I distributed, and you should each have the chapter. And what I hope will be a new textbook dealing with IRD. So everyone should have that chapter, and that's the chapter you should read for the final class 2 weeks from today. All right? And let me just play that out. 2 weeks from today, is that 2 weeks from, when is Thanksgiving? I'm losing my hair.
It's 3 weeks from today.
So it's 3 weeks from today is Thanksgiving.
No, it's 2 weeks from today.
3 weeks from tomorrow is Thanksgiving.
No, 2 weeks from.
Thanksgiving is 22nd, it's early this year.
We're meeting again on the 28th, I think,
So, yeah, our next class is actually 28,
which is 3 weeks from today.
3 weeks.
Yeah.
All right, so, you know, in theory, aside from me going to New Orleans to do this moderation or this tax panel, don't think I've left town. I am here, so as you study and hopefully master the material, if you come across questions or issues, reach out to me. I am very reachable, okay? So this will give you a really unique opportunity, guys, to hone in on your subchapter J skills. So don't wake up 3 weeks from now and say, gee, now it's time to study. Because we'll have our class 3 weeks from now, and then game on, the exam's the following week. So just keep that in mind. Simone?
Because the exam is cumulative, how long will we have to take the exam?
I'm not quite sure yet, probably 2.5 hours, maybe, somewhere in that range. All right? Other questions, issues, concerns? So that should give you a lay of the land. All right, so with that in mind, because we have a lot of questions on the charitable end, let's talk about beginning on page 329. The authors, at the very end, just want to talk about some of the consequences of grantor trust status. And the only takeaway from Revenue Ruling 69-70, the one takeaway from this, is that the law here has changed, okay? So the Revenue Ruling doesn't mean much. But the point of the Revenue Ruling is if grantor trust status does apply, so that means the grantor is going to be taxable, then whomever is getting distributions from the trust will not be taxable. So that's the only takeaway from this, is that if the trust warrants grantor trust status and a distribution is made to some other party, the recipient is not going to be getting a K-1. I mean, the simplest example of this is if Clitty set up a revocable trust and it earns $100,000 of interest income, and the trust makes a distribution to me, Clitty, I'm not going to be subject to tax on any interest income. You are. The Edgar case, this is a case which has a questionable outcome. In this case, the taxpayer, it was considered a grantor trust as the income, but a non-grantor trust as to the corpus, okay? Grantor trust as the income, non-grantor trust as to the corpus. And here, there are certain partnership losses. And the question is whether or not those partnership losses pass through. Do the partnership losses pass through? And the court here says no, even though but it's not a complete, let's put it this way. If it was a grantor trust, like in the example I just gave you with Clitty setting it up, and the partnership was owned by the irrevocable trust, and the irrevocable trust, the partnership had losses, would those losses flow through to the beneficiary? Because we know, do losses generally flow through trusts?
No.
The answer is what?
No.
No, with one exception.
Termination.
The termination, right? Because section 642H, right? And here, this trust has a foot in both worlds. And the court held because it wasn't a grantor trust as the principal, that the losses did not flow through. If you read the material that follows, it has the authors, or textbook authors, question the outcome. That doesn't mean that this issue has been resolved. They just question whether or not the reasoning of the court is persuasive. So I think implicit in the authors raising the question is this issue has not been resolved. Okay? This issue has not been resolved. All right. The authors on page 333 talk about return requirements. Generally, grantor trusts are supposed to file a return and just attach to the Form 1041 a listing of the income they earn and to whom it will be taxable. So if it is a grantor trust, it doesn't have to complete a Form 1041. Aside from the front page, it's like becomes an informational return, coupled with who is the grantor. All right. So again, the IRS just wants to follow the money stream, so that again, if Clitty sets up a revocable trust and it invests $100,000 in a CD and it gets interest income of $5,000, the 1041 should report the interest income as an attachment to the 1041 with Clitty's Social Security number, because by doing that, it can follow that now that that interest income should show up on Clitty's tax return, individual 1040. So it's just a matter, because the bank will issue the 1099 to the trust, right? So the IRS, if it's going to connect the dots for its matching program, has to see that the money was reported by the trust, but then it will be picked up by Clitty. Grantor trust status may not be forever, right? Typically when people set up revocable trusts, on their demise, the trust becomes irrevocable, right? And it's no longer a grantor trust because the grantor is no longer with us, right? So grantor trust status can terminate, and it can be done in a way that, either the trust terminates because the person grantor dies, or someone like Clitty decides, hey, I'm going to revoke the trust. Right, just to get a good sense of where we're at, look at page 334. Let's go through these problems because I do want to get through the charitable trust. So I don't want to spend too much time on this. All right. So we have G creates a inter-vivos trust. All the income is to be paid to G during G's lifetime. Upon G's death, the trust is to terminate, and the trust principal is to be distributed to G's then living issue per stirpes. This year, the trust receives $10,000 of dividends, realizes a $2,000 capital gain. The trustee receives compensation in the amount of $1,000, and G receives $9,500 of income. Why $9,500? Because under the Principal and Income Act, the trustee commission is payable half from income, half from corpus, right? Under the Principal and Income Act, right? That's in the back of our textbook in the appendix. So that when G pounds on the table, G is probably only entitled to $9,500 of fiduciary accounting income. What are the tax consequences to G and the trust? Well, preliminarily, you gotta answer the question, is this a grantor trust? Is this a grantor trust?
Definitely in regards to the income.
Alicia, say, with regard to the income, what's your authority?
671.
Well, 671 just talks about the
Okay.
tax consequences.
One of those.
So what code section, let's put it this way. Alicia's right, but what code section makes it? What code section? Anyone want to make sure? James, you were gonna say?
Is it 677?
677, everyone agree? To retain the income, 677A1. But what about the corpus here? It's not, right? Everyone agree? So it's a grantor trust as to income, non-grantor trust as to the corpus. So, given that, what would G be taxed on? Shai, you have any thoughts here?
Should be an I, 9,500.
That's fiduciary accounting income. That's how much he's going to get. Right? He will get 9,500. Will he be taxed on the full 9,500?
No, I don't think so.
No? Okay. What would he be taxed on? Karen, you were going to say?
9,000?
Okay, why 9,000?
So we deduct the whole fees.
The trustee commissions are deductible. Everyone agree?
Yes.
I have.
Right, the trustee commissions are deductible. So the taxable, the grantor is taxed on the income of 10,000, less than $1,000, right, of the fees, because those are deductible under Code Section 212, right? They're not subject to the 2% floor because under Code Section 67E, they're unique to the trust. And they're not disallowed as a miscellaneous itemized deduction. What about the 2,000?
Will be taxed.
Taxable to the trust? So that would end up on a Form 1041, and there'd be a $100 exemption because it doesn't pay out the income, right? So the trust would bear a tax on $1,900. Everyone agree? Makes sense? Again, the grantor trust as to income. All right.
Sorry, so G is 9,500 and.
No. G is 9,000. It's the 10,000 less than $1,000 of expenses.
And the trust is 2,000 less the.
$100 exemption. You got that?
Yeah.
4-25. This year, G creates an intervivos trust. All the income is to be paid to G's sister for 11 years. Thereafter, the trust is to terminate, and the principal is to be paid to G. This year, the trust receives $10,000 in dividends, realizes $2,000 capital gain. Its trustee receives compensation in the amount of $1,000, and S receives $9,500 of income. What are the tax consequences to G, S, and the trust? John, you have any thoughts? So what does that mean?
He's,
Javier, do you agree? Which one? Who's right?
I didn't hear.
Say again?
I didn't hear what date, what Karen's.
John, you want to repeat it?
I said 9,000 to S.
Okay, Karen?
I thought she was gonna get taxed on it, but
Oh, just
I didn't get a chance. to think
defend
about
your
it.
position. Javier?
Do we need to first determine if this is a grant or a trust and then see?
Oh, we have to decide, is it a grant or a trust, right? John, is it a grant or a trust?
Yes.
Okay, why? What's your authority?
677.
Is it 677, Carlo?
Would it be 674?
Would it be?
Split?
673, right? It's a reversionary interest, right? So, John, once you say it's a grant or a trust, then who gets taxed? Simone, who gets taxed? The grantor, not the sister. So, Simone, how much does the grantor get taxed on? How much? Why 9?
Because the grantor trust is $10,000,
Is that it?
and it paid the fees of $1,000.
Anything else, Simone? Harsh, anything else?
And plus the 9,500. Wait, someone else is not right. Only it's taxed on everything.
I'm asking you what G gets taxed on. You're saying G doesn't get taxed on anything? I thought you just said G gets taxed on everything. But you're leaving out one component, right, Harsh? Just say loudly, we're being taped.
$1,000 worth of compensation to.
So how much would you tax G on?
$9,000.
What did the trust earn here, guys?
10,000 plus
Plus?
2,000.
Plus 2,000.
That's tough.
Who's gonna tax on that 2,000, Harsh? Simone, who's gonna be taxed on the capital gains? Say it loudly. Why the trust? If he's got the reversionary interest in this code section, it's a grant or trust as to the whole.
So the grantor is gonna get taxed on that. So it's 11,000.
Well, it's taxed on 12, but then a deduction of 1,000. How much does his sister get taxed on?
9,500.
0. You're not gonna tax it twice. And that's what that revenue ruling, the one that's obsolete, 69-70, says that if it's a grant or a trust, right? And that's the example I gave with Flippy.
I thought this was outside, she got an additional it was an additional $9,500 for revenue generated.
Yeah, but it wasn't.
Okay, I got it.
All right, I mean, you gotta know this for the exam. And you gotta know this in practice, right? Grantor and trust, right, John? You're gonna be, in this case, it's not a part grantor trust, part non-grantor trust, right? It's a grantor trust as the whole, right? Because the reversionary interest. So the grantor is taxed on the entirety of the income, right? Including capital gains, right? You guys kept leaving off the capital gains, but they gotta be taxed to the grantor. And the sister, even though she's the real winner here, because she's getting the cash, she's not paying tax on it because it's already been taxed to the grantor. Everyone can do this? Everyone can handle this?
Well, I mean, the answer is kind of chalky because it's $12,000 taxable income. However, there's a fee of $1,000, so.
Right, but he can deduct that case.
I know, but when you ask, what are the tax consequences, do you want us to like label that out exactly how?
You could say he's taxed on 11,000.
Okay.
Either answer would work for me. Minus what? No, there's no 100 exemption. It's a grantor trust.
Yeah.
There's no 100 exemption here, guys. The 1041, it doesn't even get complete here, right? You only complete that if there's a complex trust.
Can you just repeat why would I want to do this trust then, seeing as though, as you said, the sister is the real winner?
You want the truth, Carlo? No one in their right mind would do this trust, okay? Truly, no one would do it, okay? I've never, but you don't mind me saying, and this is, I had to give a, I think I told you guys last Wednesday, I was requested to give a lecture at Roots Restaurant in Morristown. Well, this was the second night last night. There's a fairly wealthy crowd there, and I'm giving my lecture. And I don't want to exaggerate, but half the people sort of said, you know, can't I just do this on LegalZoom, okay? So when you ask your question, you know, someone gets on LegalZoom, Carlo, and they say, oh, can you help me fill out the tax return? And you look at the terms, and there's a reversionary interest. Things like that happen these days because people don't know what they're doing.
Yeah.
And they could have multi-millions, but they're going to save $1,000 and they're going to do it themselves. They get themselves in trouble. All right? So when you ask who would set up this kind of trust, never seen it. But in yesteryear, let's just make it a point clear. Was this a popular kind of trust, what we just saw here? Absolutely, categorically, very popular because this is the quintessential Clifford Trust, right? And this used to work. All right? So you ready? 4-26. So we're just on page 334. I'm almost finishing up in the textbook. And then we're going to get into the charitable trust. Okay, so I know you're anxious for that. Okay? (4-26). Assume the same facts as 4-25, except the trust is to terminate after a period of years long enough to avoid application of 673. So, Carlo, this trust may go on for 30 years, right? We've been there, done that, right?
Determination, like years?
No, the trust may go for 30 years and then it's going to revert back to the grantor. But it doesn't run afoul, right, of Code Section 673. Everyone agree? They're not going to run afoul of Code Section 673.
So does that mean that it's part and part?
Well, you tell me. That was my next question, Carlo, so that you can read my mind.
Yes.
Okay, which part is which? And what's your authority? So Carlo's asking the right question. This is a grantor trust, right? And he's saying it's not a grantor trust under 673, right, anymore. But is it a grantor trust under one of the other provisions, right, Carlo?
Like 674? No?
What's going to happen here?
Or 677?
Say again?
677?
677, A2, right? Code Section 677A2, because ultimately the corpus is going to inure to the benefit of the taxpayer, right? The corpus is going to inure to the benefit of the taxpayer. Okay? So now that you know that, okay, everyone take a deep breath. We know that 677A2 applies. So it's a grantor trust as to the principal. It's a non-grantor trust as to the income. So given what we know, 10,000 of dividend, 2,000 in capital gain, what's going to happen here?
grantor with respect to the principal?
The principal is going to inure to the benefit of the grantor because after 30 years, the corpus goes to the grantor. His interest in this trust, let's say, is 4%. He has a 4% reversionary interest.
Okay, so we're assuming a high enough
High enough interest rate and
Okay.
long enough years
Okay.
that his interest here is going to be pretty meager. But after 30 years, his actuarial interest in the trust is 4% or 4.9%, something less than 5%. Everybody agree? So who's going to get, Simone, this has your name on it. Who's going to get taxed on the capital gains here, Simone?
So the trust.
Dave, agree or disagree?
I agree.
You didn't say, and Shang, final word?
What's the question again?
Who gets taxed on the capital gain?
The grantor, G.
Isn't that what it is? Isn't the capital gain inuring to the benefit of the grantor? So the grantor gets taxed in the year 2018 on the capital gain, right? What about, how do we handle the dividend? We're going to go down memory lane. You guys ready to go down memory lane? We should bring you back to memory lane. Since B is taping this, you got to write it really big. Fiduciary accounting income is what? Well, 10,000, right? Less 500, right? So it's 9,500 is fiduciary accounting income. What's gross income here? What is it?
12,000.
No, capital gains is 0 because we know it's tax. We're now computing the gross income for the trust, right? Because the trust is now going to have to complete a 1041 because we're just back to the rules that we learned the first 10 weeks of the course, right? It's a grantor trust as to capital gains. It's a non-grantor trust, and we've only looked at non-grantor trust the first 10 weeks of the course, right? Everybody agree? So we're back to our old world of $10,000 of dividends, 0 capital gain. So 10,000 of gross income. What's our tentative taxable income, guys? Tentative taxable income is what?
Minus exemption.
So we start off with what? 10,000
Minus 100.
minus how much?
Hun.
Why 100? Doesn't it pay out all income?
It does. 300. Exemption. And then commissions.
Minus commissions.
$1,000.
So we're down to 8,700 in tentative taxable income. What's D&I here, guys?
Add back exemption. And that's it.
D&I is 8,700 plus 300. Modified D&I, right? We have no tax exempt income. So modified D&I, or the income distribution, is going to be $9,000 as well, right? So the tentative taxable income of the trust is going to be 8,700, right? Which is the tentative taxable income, less what? Taxable. Less what? The distribution deduction of 9,000, right? Here's a shocker. It's going to be, the trust is going to have negative $300 worth of taxable income, right? You could have probably eyeballed this, right? And said, come out with the same outcome, right? Because the sister's getting all the income. How much is the sister going to be taxed on, guys?
9,000.
9,000, right? She's capped at the amount of D&I, right? None of which is tax exempt. And we can see the bifurcation. Part is treated as grantor trust, picked up by the grantor. The non-grantor trust is just the regular rules that we've looked at. (4-27), assume the same facts as 4-26, except the trust is revocable. So clearly this has your name on it. In that case, is it a grantor trust, Clay?
Yes.
As to the whole or as to a part?
Part.
Okay, I'll ask Javier, agree or disagree?
I would agree.
Okay, if you say that, then you better be able to tell me which part is which part.
Well, when it's revocable, that means that it's not a grantor trust.
And it's what, Clint?
When it's revocable, it's not a grantor's trust.
It is or is not?
Isn't.
What is it? Well, isn't a mark of a grantor trust is that you have control over the assets, right? That's a metric. If it's a revocable trust, do you have control over the assets?
No. You do.
All right, can you revoke it like this and just take back title?
Right.
Isn't that pretty close to ownership? Is it a grantor trust? Is it a non-grantor trust?
Grantor.
It's a grantor, right? It's grantor to the whole. So it's grantor to the whole. The grantor will be taxed on all the income. End of story. Grantor picks up 10,000 of income, 2,000 of capital gains, and pays the trustees commission, can get a deduction.
And this deduction would be, at this point, the new law not allowed, because it's older than.
It's a little bit weird, because first of all, with revocable trust, I've never seen anyone pay a trustee commission, because they name themselves as the trustee. So, it wouldn't do anything, because they would have to take a deduction and pick it up in their income. So, as a practical matter, it creates kind of like this false world. All right. So that's my only takeaway here, finale. I told you that I wouldn't worry about anything that follows here about the collateral consequences. I know, again, I know there's a lot of tears going on as we close the book on this, but so be it. Hopefully, I say with some trepidation, that you found it easier to read my proposed chapter 7 than our textbook. All right. So we'll see. Right now, just to bring you up to date, this book, it's when you work with co-authors, you always have to be careful. This book I was hoping would be ready to be distributed to you this semester. We began it in the beginning of this year, but just everyone has their own work schedule. Let's put it that way. So it's coming along slowly. It's all written. Now it's just a matter of trying to coordinate and make sure it's everything jives with each other. So we're making progress. So keep you posted. All right. So charitable trust, guys. Now let's talk about charitable trusts, and generally, for your information, they come in 2 flavors. And you can pick up a whole bunch of acronyms tonight, guys. And I'll make a hit of the party, and since I don't think we have class until after Thanksgiving, you know, you'll be the hit of the Thanksgiving table if you start talking with these acronyms at your side. So, charitable trust. And like I said, they come in 2 big flavors: charitable remainder trust and charitable lead trust. Those are the 2 biggies. And I'm going to make a statement that I don't think is too bold on my part. My statement is that, at least based on what I can tell, and I did not do a study of this, this is just what I think from my perception of the world, is that 95 to 97% of all trusts created out there are which of the 2? Remainder trust or lead trust? The remainder trust, okay? Charitable lead trusts do not come up with major frequency, and that maybe it's just based on the clientele I have. Like, you've got to be beyond uber rich, in my opinion, to set up charitable lead trusts.
Did you say remainder and lead, as in, what's the second one?
Charitable lead trusts are not as frequent as charitable remainder trusts. Okay? Hello? So, the emphasis, my emphasis will be primarily on charitable remainder trusts, because those are the ones that you're most apt to see in practice. Now, charitable remainder trusts, there's a further breakdown. And this is true with respect to charitable lead trusts. The 2 flavors of charitable remainder trusts are charitable remainder annuity trust, a CRAT, C-R-A-T, charitable remainder annuity trust, and CRUT, charitable remainder uni trust, okay? You gotta get the lingo. You could have a CRAT or a CRUT. Do you know the difference between the 2? Alicia, what is the difference between a CRAT or a CRUT?
As far as I remember, the one with, the annuity pays annuity to a,
The charitable remainder annuity trust pays a fixed dollar amount to a beneficiary. Fixed dollar amount. What about a CRUT? A fixed percentage, right? Fixed percentage. So, which one has more variety, so to speak? A CRUT. Why? Because each year the assets of the trust may vary. If the value of the assets vary, you're going to the person who's going to be the non-charitable beneficiary is going to get a fluctuating amount, right? In contrast, with respect to a CRAT, it's a fixed dollar amount, right? And that's always going to be the same during the entire term of the trust. And just for your information, a CRAT, you cannot make additional contributions. Once you set up a CRAT, that's it, game over. Where when you set up a CRUT, you can make additional contributions to a CRUT. CRAT. You can't make additional contributions. A CRUT, you can.
Correct, you can't.
Can. A CRUT, you can. Now, as I spelled out on page 1, with respect to charitable remainder trust, certain conditions have to be met in order for it to qualify. And the annuity, if it's a CRAP, the annuity amount cannot be less than 5% and not more than 50% of the initial fair market value. And if it's a unitrust, the unitrust percentage cannot be less than 5% and not more than 50% of the fair market value valued annually. Now keep in mind that you probably don't want to put hard to value assets in a CRUT. Why? Because if you do, every year you may have to get an appraisal done, right? So my experience is with CRUTs, you don't want to put things like real estate in because that can be problematic because every year you're supposed to value the real estate. That's not a problem with a charitable remainder annuity trust because there's a fixed dollar amount, right? The payments must be for the life or lives of individual beneficiaries or for a term of years not in excess of 20 years. So you can set up a charitable remainder. Remember, what ends up with the charitable remainder trust, and hence its name, is I set up a trust for 15 years for Young Hung to get an annuity amount. And after 15 years, she gets the annuity amount each year, every year. And after 15 years, it goes to the Red Cross. And we get that, hence its name, charitable remainder trust, because the remainder passes to charity. And sometimes I say, gee, I want Young Hung to have a lifetime of $10,000 per year. So I'm going to contribute this property to this charitable remainder trust. Young Hung will hopefully live a long life, and I know for every year she's going to get $10,000 per year. On her demise, it will go to the Red Cross. So you can have it for a term of years or for her life.
And
Was the minimum 20 years, you said?
The maximum is 20 years.
Oh, maximum.
But in lieu of that, you can have it for over someone's life. But I can't have a 30-year term. Go ahead.
can the beneficiary be reassigned?
And the beneficiary,
Like the charity, like what's,
you can change the charity,
who can change it?
the grantor. Okay? Okay, so we're going to go through some examples of this. Upon the termination of the non-charitable interest, the remainder must be held in a continuing trust for charitable purpose or paid to the use of one or more charitable organizations. And the present value of the remainder interest, okay, that's the amount of donor's charitable deduction, must equal at least 10% of the initial fair market value of the assets contributed to the trust. So if I contribute $1 million, okay, there must be at least a 10% interest that will actuarially inure to the benefit of the charity. And that will depend on interest rates, and it will depend on if it's for Young Hung's lifetime, how young she is, or if it's for a term of years, how many years. And you might say, gee, there's a lot of number crunching we're going to have to do here to see what happens. Well, you know, in this day and age, there's lots of computer software programs out there that will do this computation like this. You just have to enter in the interest rate. If it's for a lifetime of one person, their age, well, you know, you just enter it in. You know, you press the enter button, and I have a program called Number Cruncher. Number Cruncher gives me a number in 3 seconds. I'm exaggerating, not 3 seconds, 3 milliseconds, okay?
And that would be the number that the beneficiary can take every year annual, yes?
No, the number I'm talking about is the charitable deduction, okay? But the charitable deduction has to be at least 10% or more of the fair market value. Remember, if I set this trust up, a portion actuarially is going to inure to the benefit of the charity, right? This is called, and it gets, think about the name. These are called split interest trusts, right? split interest. Why split interest? Because there's a non-charitable beneficiary and a charitable beneficiary. Again, split interest trust, right? Simone, you got that? Yeah.
No, I'm just thinking like ahead, like, how does the annuity portion work? Like, does it go, like, are there fixed payments that go to the charity?
No. Remember, this is the remainder interest, just like a block, goes to the charity.
Right.
The annuity amount is for the non-charitable for her lifetime or term of years. Okay? At the end of the trust term, whatever that may be, the money is supposed to, in my experience, just go to the charity outright.
And are you saying that all charitable trusts are grantor trusts?
I didn't say that. You didn't hear me say that. Anyone hear me say that?
Just asking, sorry.
No, it's fine. You might as well test the water. And we're going to talk about the taxation of the beneficiary in a few minutes, but we're just trying to get the lay of the land, get the vocabulary, because just like once you have vocabulary and you know how to apply the vocabulary, it makes it a lot easier to know the consequences. But if you don't know how to apply the vocabulary, then what are we even talking about? What are the consequences? So it's good. These are good questions. Now I'm just trying to help everyone understand or identify what is a charitable remainder annuity trust versus a uni trust, and B, you write your hand.
Carlo and I were wondering if the trust terminates after the primary beneficiary dies.
If the terms, you could have it being held in further trust for the charity, or it could just go outright to the charity. My experience just goes outright to the trust terminates and it goes to the charity.
I'm sorry, was that what you just said to her? Never mind. I think I made you repeat what you just said. Okay.
I'm not sure. And if I did, that's okay, because this is new to many people, so repetition doesn't hurt here.
So you're gonna still invest this money, right? So, but the income amount doesn't really matter.
All right, let's be careful about the pronoun you, so just elaborate.
So the trustee is gonna still try to invest the money to make it obviously last longer, especially if we're talking a lifetime thing. But the annuity amount is set, no matter how much the income
Right.
actually turns out to be. So you could be eating the principal every year and run out,
Absolutely.
and then the return is nothing.
Ideally, if you don't mind me saying so, this trust works particularly well where, let's say, I'm going to make up an age, is 30 with an actual lifespan of 50. Just make that up, okay? And based on that, the charitable deduction, if we contribute $1 million, might be, say, 200,000. Just make up a number, 200,000. If I set up this trust for Young Hung's benefit, actuarially of $1 million, 800,000 is her actuarial interest, 200,000 is the charities, right? Everyone agree? But if Young Hung does her job and lives to be 100, so she doesn't just live 50 years, she lives 70 years, is that the charity, even though I was able to secure when I set this up, a $200,000 deduction, truth is the charity's going to get a whole lot less, right? Everyone agree? And I really got a juiced up charitable deduction. Now, Young Hung, if Sally gets hit by a bus tomorrow, then I could have contributed the whole thing to charity, right? It got a $1 million deduction, and I only got 200,000, so it wasn't a great deal, right? So you want to choose the right people to be the measuring light, those who have long lifespans, right? Because then you get the most bang for your buck. This is the antithesis of life insurance. It's a much better deal if you stay above ground than below ground.
This just seems to be too many random variables then. How is your computer doing this in 3 milliseconds? There's too many things that could make
No,
it
there's not that many
the present
factors.
value of 10%.
No, I mean, we just go with standard tables.
Okay, so then, all right, doesn't really matter.
So, I have a question.
If you're only a little confused, that's not bad at this stage, but me, hold on 1 second.
What are the kind of games then that can be played then to get the beneficiary more money? Can the beneficiary?
The beneficiary, no. These aren't even games, because Young Hung just has to eat healthfully, okay, and stay above ground. That's not a game. There's no games. I mean, and let me just make the observation, because the chapter tries to there used to be games. Before 1969, you could set up charitable remainder income trust, okay? Where monies were being, you would put in $1 million, and then you could pay out the income to the beneficiary, and you could manipulate that, right? Everyone agree? That's somewhat manipulable based on the investments made. All sorts of games could be played. After 1969, Congress said, you know what? This has become a farce. We're going to really shoehorn or handcuff the taxpayer. You've got two choices here, and really, an annuity trust and unity trust, not too much games you can play.
So there's really not a minimum amount of original contribution that has to be given to charity. There's no such a requirement.
Minimum contribution to?
No, minimum amount that must be left to charity.
There must be.
There is.
There's a 10%.
It's 10% of the
Your original fair market value.
original from, okay. So
Now, it may prove subsequently that in my example, where Young Hung lives to be 120, then the charity got shortchanged. But at least when the trust is set up, actuarially, the value must be at least 10%.
Okay, so there's no penalty if the person lives longer than
No
12.
penalty.
Okay.
You don't have to bury the person or take a
So
gun.
I'm trying to figure out.
No. Once it's set up and it meets the test, it's good.
The value of the charitable contribution should be at least 10%
Yes.
of the
Of the
entire.
entire fair market value of the contribution. And speaking of healthy, I don't know, I'm always impressed. I think I mentioned this last time since we met. I think on Sunday was the New York Marathon, which, by the way, your husband ran.
Yes.
Well, how did he do?
He finished it in 5 hours and 22 minutes.
Everyone got that?
5 hours and what?
22.
And what's his age?
48.
I have a bunch of friends that used to run marathons.
On the record, if you Google him, you'll see that he's 47, but he's really 48.
Shh. That's even on tape.
Yeah.
All right.
He's not
Anyway, very impressive for him. But when you see these people running it in like a little over 2 hours, and you say it's 13 miles per hour, I said, you may have heard me before, I just in awe that the human body can do that, right? But whoever ran the marathon, I doubt if they will have such a good command over charitable trust, right? So everyone brings their own expertise to the table, right? Anyway, so there's certain conditions. These are spelled out in Code Section 664 that have to be met. I mean, this is not just coming from me. This is coming from, not surprisingly, Internal Revenue Code. And I do point out, and again, the computer does this, is if you look at on page 2, the second full paragraph after the 4 conditions says, in addition to the 4 requirements listed above, regarding a CRAD, the IRS takes the position that a charitable deduction is not allowed for gift to a charitable remainder interest in trust where there is more than a 5% probability that the charitable remainder beneficiaries will not receive any trust corpus. Now, again, this seems like the 10% test, but it's actually a different test, and it's based on the fact that if the annuity amount exceeds the 75-20 rate, okay, let me repeat that. Every month, the IRS publishes what it considers how to compute the remainder interest based on the current interest rate. And that current interest rate is found in Code Section 7520, right? You can Google Code Section 7520 for the month of November. Okay? If you Google, Dan, can you get access to the internet here? Can you Google Code Section 7520 rate November 2018? Is it like 3.4? I don't know what it is. Did it come up?
Check.
Nothing coming up there?
3.6.
3.6? Okay, 3.6. Okay? if you have an annuity payment in excess of 3.6%, let's say you make the annuity amount 4%. At some point, the expectation is you're going to exhaust the principal of that trust because you're going to dig into principal. Everyone agree?
Yeah.
So, in theory, you could meet the 10% test, but your computer, my number cruncher program, also runs this additional 5% probability test too when it comes to CRATs. So I'm just sharing with you that with respect to CRATs, there's this fifth condition that has to be met. This 5% exhaustion test.
What if the corpus is invested nicely and gives
Well, what Congress is trying to achieve here is that if you get a charitable deduction, it wants to make sure that the charity gets something, okay? I mean, that's the bottom line because, again, what was happening in 1969 and before was people were setting up these trusts, getting real robust tax deductions, and the charity had nothing to show for it. Well, that's not good public policy, right? To give people charitable deductions for monies that don't ultimately go to charity. All right? Now, we know that there's two main kinds of charitable trusts, right? Charitable, when I say remainder trusts, there's charitable remainder annuity trust, CRAT, and CRUTs, right? But, as I point out on page 2 and 3, just to add to your growing repertoire of acronyms, unit trusts come in several flavors, actually 4 flavors. There's the standard CRUT, and then there's what's called a net income CRUT. Okay. That's number 2, where what it does is it pays out the lesser fixed percentage or net income. Pays out the lesser of the 2. Or you have a NIM-CRUT, which pays out the lesser of the 2, but then it has a so-called makeup provision.
What was it called?
NIM-CRUT. NIM-CRUT. Page 2, item 3 towards the bottom there. And then you have a so-called flip charitable remainder trust, where it begins as one of those 2 and later converts to a standard CRUT, a flip CRUT. Now, I just want to share with you, I've seen regular CRUTs and I've seen NIM CRUTs. And let me explain, why would anyone do a NIM CRUT? Like, what is the motivation behind a NIM CRUT? Right. The motivation is, suppose you're an executive and you're making lots of money, the highest tax bracket, right? And you want to set up one of these trusts, and maybe you're going to retain the income interest and the balance is going to be paid to charity. And if you have the trust pay the lesser of the income or the fixed percentage, and it's invested in a way that pays virtually no income, and then after 10 years when you retire, and your income now is very low, right, because now you're retired. Now you have the trust invest in change the investment portfolio. So now it's get high yield bonds. So now the makeup provision kicks in. So it's paying out a ton of income, okay, in excess of the percentage amount. And as a result, the person can now, because they're now in lower tax brackets, they can use this like as a retirement fund. So, and you might say, I have no clue what he's talking about, okay? That's fair on your part. We're going to go through an example where we're going to see a NIM-CRUD in practice, and you'll get a sense. My point is, you can have a standard fixed percentage every year, pays out a percentage, say 10% of whatever the trust assets are, year in, year out. Or you can have one of these NIM-CRUDs where it pays the lesser of the income which is generated for a fixed percentage. So if the trust that I set up for Young Hung, I put in $1 million, okay? And she's supposed to get $100,000 per year, or the trust generates, say, it's invested in Apple stock that pays 1%. So instead of getting, in my example, 10% or 100,000, it's paying 1%, which is 10,000, right? Everyone agree? Did I do my numbers right? So she's only getting a very small dollar amount, but each year there's a $90,000 buildup if I did my numbers right. And after many, many years, after 10 years, there's $900,000, right, of buildup, makeup. And then if that is now, that $1 million is reinvested to pay out a lot of income, for some reason paying out, suppose it gets a 25% return. Instead of investing in Apple stock, we invest in junk bonds that pay 25%. So it would start paying $250,000 for several years until it used up all that shortfall in prior years. So I'm playing around with numbers in my own head. I hope I'm not losing you, but if I am, we're going to go through some real numbers in an example shortly. All right, so my point is, with respect to CRUDs, there's 4 variations. CRATs only come in 1 flavor. It's not Baskin Robbins, okay? CRUDs come in 4. I'm not going to ask anything about, I just call your attention that rules that are, certain rules that apply to private foundations, this is on page 3, also apply to charitable remainder trust in the second full paragraph. So there's certain rules that you have to worry about potential excise tax application, excise taxes, about self-dealing and all sorts of other things that I just want to call to your attention. All right. What the income taxation of charitable remainder trusts, right? Let me make clear that generally charitable remainder trusts are not subject to tax. Okay, that's the good news, right? They're not subject to tax, unless they generate what's called UBIT income, unrelated business taxable income, so-called UBIT income. This is spelled out on page 3. And let me just make the observation that 99.9% of the time, charitable trusts will not generate UBIT income. They just won't. They won't invest in things that will give rise to unrelated business income. Like if you're a trust, a charitable trust, unrelated business income is if it generates, it starts a business. Like the famous example is Muller's Macaroni was started by a charitable trust, and it was problematic because if you're a charitable organization, generally do you pay tax? No. And if you're competing against enterprises which are taxable, obviously you're going to be at a competitive advantage. So Congress said, hey, if charities generate taxable income in the form of business income, if you look at Code Section 511, 512, 513, 514, Congress says, even though they're charitable, they will pay tax. So I'm just sharing with you, I've never met a charitable trust that engages in business because there's no upside, because there's 100% excise tax, right? All right, so how does the tax, assuming that the charitable trust doesn't make one of these investments, how is a charitable trust taxed? And there's a tiered system, okay? Pointed out on page 3. It's generally based on a worst in, first out system. And there's 4 tiers, spelled out on page 4. Okay? Whatever's paid out, to the extent the trust has ordinary income is paid out. Next tier, to the extent the trust has capital gains. Tier 3 is tax exempt income. Tier 4, trust principal.
When you say paid out, could you just be more specific?
Whether it be the fixed dollar amount, annuity amount, or the uni trust percentage. So we're going to go, so if the trust, in my example with Young Lung, had interest income, that interest income that gets paid out would be subject to tax in her hands.
Not in the trust hands, in her.
Yeah, the trust is not subject to any tax.
That's, I was getting confused with that, because charity would have said, like, it's not taxable, but it generates income.
Generates income, and to the extent it's paid out, she's subject to tax on
What if it's not paid out?
it. It has to be.
It has to be.
But let's say the trust, let's say the annuity amount is 100,000 in my example, right? I contribute $1 million, she's supposed to get 100,000, and the trust generates 150,000 of income. 100,000 will be distributed to her, 50,000 will remain in the trust, right? Not subject to tax because the trust doesn't pay tax. But the next year, if the trust earns no income, but still has to pay her 100,000, the first 50,000 will be subject to tax as ordinary income.
So it's like a carryover?
Absolutely. And we're going to go through some examples. Okay? But absolutely carryover. And if you don't mind me saying, if you look at page 5, Simone, that top example is exactly what we just spoke. Do you have the
No, I
handout?
don't have one.
All right. In this example, if you have it, you can look down at Alicia's shoulder. But I mean, I wrote it out here. In this example, a CRUD is required to pay $50,000 per year to a non-charitable beneficiary. In the year the CRUD was established, it had $10,000 of undistributed ordinary income and $10,000 of undistributed long-term capital gain. So year 1, okay? So year 2, it has 20,000 of ordinary income, 10,000 of capital gain, 10,000 of tax exempt. Year 2, the $50,000 distribution to the non-charitable beneficiary will consist in this order: $20,000 of ordinary income earned in year 2. That takes care of 20 of the 50, and 10,000 of the undistributed ordinary income from year 1. This was not distributed in year 1. And 10,000 of capital gain. So now we're up to 20, 30, 40. And $10,000 of undistributed capital gain. So we covered all 50,000. So it's a worst in, worst out. So
Worse than in terms of the tax.
tax consequences. Now the authors do point out, you got to be careful, I'm the part of the authors here. I didn't write this chapter, but I had to work on it a lot. So page 5, tier 1 is ordinary income. What's unusual about tier 1 is that it has ordinary income and qualified dividends. So it's not, Simone, the worst case scenario because qualified dividends are taxed at 20%. And tier two, as I point out, several different tax rates, right? Including short-term capital gains at 37%. So you have to read these examples, but there's, even though it is tier one first, then tier two, then tier three, within tier one and tier two, there's different tax rates, and you've got to look at the worst one first in application. So I'll leave that up to you. I like to think what's written here is somewhat self-explanatory. The reading for this week, guys, I like to think is a lot easier than the textbook. So if you haven't had a chance to read, try to go back through this. And if there's a problem or an issue, I'll just try to highlight some things here that hopefully make sense or make more sense with my discussion of it. All right, so I'm just flipping pages and highlighting those things, and I just have to be careful of time. Planning with, getting to page 10, planning with charitable remainder trust. You know, people, my experience is a lot of people like charitable trust because a lot of people want to be charitably inclined, or they are charitably inclined, but because they don't know when they're going to pass away, they want to have this routine income stream. So they want to have this annuity amount or uni trust amount because for the rest of, often they set it up for themselves. They set it up, they contribute, say, $1 million to the trust, and they retain the interest for a term of years in their lifetime. Many times it's for their lifetime, because this way, they, no matter how long they live, assuming the trust principal doesn't get exhausted, that they're going to get an X dollar annuity amount for the rest of their lives.
Who gets the charitable deduction?
Whoever makes the property contribution. Okay, so whoever gets the income tax deduction. As I pointed out on page 11,
Sorry, just a quick question. You just said though, just before, you have to distribute it, and now you're just saying in year one, they didn't distribute any.
no, I didn't say that, but in the example, it's presumed that this was in addition, like this, that these monies were in excess of what needed to be distributed. Like the trust earned, I'm making this up,
Oh, okay.
60,000 of,
Yeah.
60,000 of ordinary income.
Contradict yourself, I see what you're saying.
So just for your notes, it's presumed in year one, this trust earned 60,000 of ordinary income. It paid out 50 of the 60 as ordinary income, leaving 10,000 of ordinary income, and it also earned 10,000 of capital gains. Pointing out on page 11, trust must file Form 5227 annually. And it doesn't pay any tax, okay? I just want to, so it's not filing a Form 1041, it's filing this Form 5227. And it has to supply a copy of the governing instrument, because the IRS has to make sure it meets all the requisites under the code. So it wants to see a copy. And just so you know,
Is it every year that you attach?
no, just the first year. Let me just say this. This is not your time in life or the attorney's time to be creative, okay? As I point out at the very end here, that the IRS has promulgated, beginning on page 19, forms. So this is not something that you want to create out of thin air. There are forms for each one of these trusts, and again, I would not look to be creative here. I would just do what the IRS is recommending, done. Don't be creative. Okay? So, there's just a few questions here, and then we'll take a break, and we'll get into charitable lead trust. Let me see if I can get through these quickly. Prior to 1969, a charitable trust was allowed with respect to trust contributions as long as the chance that the charity would receive nothing was so remote as to be negligible. Why do you think Congress changed the law by requiring the charitable interest in a trust be in a form of annuity or uni-trust? And like I said before, the concern was by having trusts that could just pay out income, they were subject to too much manipulation.
What page was that?
This is on page 11, the questions. Page 11. Now, charitable trust, CRT is required to distribute $30,000 annually. So that means that's a CRAT, right? It's an annuity amount to a non-charitable beneficiary. For the year in question, the trust has corporate bond interest of $3,000, qualified dividends of 5, short-term capital gain of 14, long-term capital gain of 6, and tax-exempt income of 6. How much income must the non-charitable beneficiary report in its character? So quickly come up with a number, guys. And if you're the beneficiary of this trust, how much are you going to report, and what's the character? Don't make it hard. So, based on the tier system, what is the ultimate amount the taxpayers can have to report dollar-wise? 30,000. Okay? Keep going from there. What's the character? Tier 1, 3,000 in qualified dividends, right? First. Excuse me, I apologize. I circled the wrong number. $3,000 in corporate bond interest. Qualified dividend next to 5,000. Short-term capital gain of 14. Long-term capital gain of 6. And, if I do my numbers right, $2,000 in tax exempt gets us up to 30, right?
Yes.
Done. Question 3. Charitable remainder annuity trust is required to make a $20,000 payment to individual beneficiary A. The trust has the following income: qualified dividends of 30 and short-term capital gain of 20. How much income must A report? What is its character, guys? 20,000 in qualified dividends, right? Right off the top, tier 1. In the above example, what happens to the income not distributed?
Being
Carried over, right? Karen, you got that? It's carried over. Question 5. Donor funds a charitable remainder trust with $500,000 in stock, which has a cost basis of $100,000. In the year of funding the trustee sells the stock. The trust paid tax on the $400,000 gain. Alicia, you're shaking your head no, right? No, right? No. No tax, right? Charitable trust does not pay tax. A charitable remainder trust has UBIT income consisting of business income from a partnership that it owns. And what happens if a trust, a charitable trust has UBIT income?
Excise.
100% excise tax. Not your savviest investment if you're a trustee, right? 100% excise tax, ouch, right? Question 7. Your client comes to you and says he wants to establish a charitable remainder trust funded with appreciated property. Once the trustee sells the appreciated property and reinvests the proceeds, wants to make sure he will not have to recognize any ordinary income tax at a 7% maximum rate of the distributions he will receive. Explain how you could achieve this result. So, can you avoid tax? I mean, you know what I hear some people say, some planners say, oh, we'll just have the person sell the securities, invest in tax-free bonds, right? And I can avoid income tax that way. Does that avoid income tax?
No, because
No.
you have the gain waiting for you.
Yeah, tier 2 capital gains are going to be distributed out. So down the road, you may be able to receive tax-exempt income, but you can't make that capital gain disappear by stuffing it into a charitable remainder trust. Right? All right. So that's probably a really good, if you don't mind me saying, break point, because then we'll talk about charitable lead trust, and then I'm going to go through some more examples with respect to charitable remainder trust. All right. So, Carlo.
For number 6, are you saying that is it 100% the rate?
It's 100%.
The rate, or just 100% of the income?
The rate is 100% on the UBIT income generated. All right. So why don't we take our 9 or 10 minute break? Come back. We'll do